Welcome back. Well, the big story of the week, the Federal Reserve raising interest rates by 50 basis points, the biggest move in over 20 years. Fed Chief Jay Powell also commenting on the possibility of a recession, saying that he will be able to have a quote-unquote softish landing. He also killed the idea of a 75 basis point hike anytime soon. Watch this.
The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point. It's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. 75 basis point increase is not something the committee is actively considering.
All right, joining me right now with reaction is Equity International Chairman and founder, billionaire investor, real estate investor as well, Sam Zell. Sam, it's great to see you. Welcome back. Good to see you this morning.
Great to see you, Maria. I haven't been with you in a long time, so it's fun.
Okay, great. So what was your reaction to Jay Powell? Do you believe they will be able to take interest rates all the way up but not take this economy into a recession, Sam?
Well, I don't know the answer to that. If I did, I'd be rich. But I think that the fact that the Fed has spent so much time not doing what it should have been doing creates a big gap that I think can be filled without much damage. In other words, I think that, 100 basis points, even 200 basis points over the next year is not likely to put us into a recession. It's just probably likely to bring us back to where we should be. Whether that's enough to slow the inflation rate, I think is a whole different question, and one that will require improvement in supply chain. It'll require adjusting the mental set. I mean, in most cases, inflation is very much driven by the presumption on the part of consumers and decision makers that it's going to cost more later, therefore. And we need to cure that.
Yeah, it's a good point because consumer spending has been pretty strong, Sam. As you know, even if people sort of shifted their spending from buying stuff to spending on travel and services, but at the same time, wages are up and they're getting eaten by inflation, running at 8.5%. We're getting the consumer price index out next week. Now, everybody's talking about that being the next major thing to watch. Do you see inflation or these high consumer prices leveling out anytime soon, given the fact that we've got this supply chain problem and a contraction in the first quarter?
Well, I don't know the answer. I mean, I would hope that be the case. I don't think there's much sign so far that we're seeing a reduction in the level of inflation. I'd be surprised if the estimate that came out next week was less than what we've been dealing with up until now. We're a long way from making any serious adjustments, and it basically comes down to extreme liquidity. The efforts by the government to respond to COVID were too much, too often, and too dangerous to the overall question of maintaining inflation controls.
So let's talk real estate, Sam, because I know that home prices are way up, even rents are way up. Assess the market for us. What are you seeing out there? I'm being told that, many people are being locked out of this market because prices are up so much.
Well, I think there's no question that prices have increased. To me, it's kind of the most simplistic example of supply and demand. Since the Great Recession of 2008-09, the number of new houses and new living dwellings, whether it be apartments or houses or mobile home parks, we're way behind the pace at which we grew prior to 2008. So for 20 years we built 1 million houses a year, and I think in 2009 or 2010 we built 250,000. And we still aren't back to the million, or we're just now getting to that million. So we've, in effect, created a big hole. And when you create those kind of holes, you end up with prices going up because there's more demand than supply. There was also a period where all kinds of people thought that millennials weren't going to buy homes, and I never understood that, and I just didn't understand that anybody would assume that the number of household formations would go down. I mean, the answer is you don't build enough houses, you don't create enough zoning, you in effect have NIMBY kind of mentality, and the result is that the scarcity pushes up the price.
Yeah, right. And that's where we are right now, right? We did not have enough building. The supply is scarce. And so are there any comparisons to the 2007 upset in housing that you obviously lived through so well? Or is the supply problem now making this moment different than the blow up that we saw in 2007 and 8?
Well, I mean, I do not think that this is a repeat of 2007 or 2008. But I think you need to take into consideration, one, that the amount of land being zoned for multifamily is way down. The number of single-family houses built is not catching up and making up for the past periods where we didn't keep up the pace. Home builders are having trouble finding people to work on, carpenters and all kinds of tradesmen who are building these houses. So, all of that kind of comes together. Again, going back to supply and demand, we're not producing the supply, and therefore, and the demand remains constant, and the result is that prices go up.
Yeah. How long can they stay up? I mean, you have such a diversified portfolio, talking about healthcare, logistics, transportation, the agribusiness, along with real estate. But you see firsthand about that shortage in labor, the truck drivers that are in such need, wages going up and still getting eaten by inflation. Tell me what levels things out then.
Well, I think that, what we're seeing in the various businesses we're involved in is a lot of wage pressure. We actually own a trucking company, and the difference between 2 years ago and today is the fact that, we probably, have overcome by raising salaries and improving working conditions. We've overcome the shortage of drivers. Now there's a shortage of containers and other things of that nature. In the same manner, we own a big hospital chain, and we're getting pummeled by the cost of employees, and particularly nurses, where we just don't have enough people to fulfill the demand. And obviously, when there's a shortage of supply, prices go up, and I think that's what we're dealing with.
Yeah, how much higher can they go, Sam? Do you think that this moderates, or do you think prices are still on their way up?
Well, I'm hopeful that raising interest rates not only will make it will adjust the impact of what's going on, but also kind of send a signal that interest rates will continue to go up until things improve. I'm not optimistic that we're going to see some kind of a reduction. I think we have a better chance of slowing the upside than reversing what's occurred so far.
So what has been the impact of 5% mortgage rates in your view, Sam? I mean, look, we have to mention that rates were all the way up to 16.6% back in 1981. But when you consider the move to 5%, that happened fast. What has been the impact?
Well, I mean, remember, interest rates are interesting points of reference, but the real controlling factor is what's the monthly payment, and the monthly payment, a year ago was based on 2.5%, and now today it's 5%, and I think that that's eliminating a lot of potential buyers in the market. I think it's putting a lot of additional pressure on those people that do buy, and that clearly is going to have somewhat of an impact on housing prices, and I think it's very possible that we may be seeing the crest of housing appreciation.
The crest of housing appreciation. So it has put people into rental situations.
That doesn't necessarily mean it's going to go down, but I think that the raise in interest rates, and as quickly as it has happened, has certainly had an impact and a slowing of the demand and the pressure on pricing. I also think in selective markets, you have big differences, between some markets where already you've seen where houses went above the asking price 6 months ago are now in effect back to a kind of a normal give and take. In other markets, they're still appreciating.
Yeah. Sam, let me just say we're getting some breaking economic data this morning. We've got the first quarter labor costs up 11.6%, much higher than the estimate, which was 9.9% on labor costs, Sam. I mean, you're living it with the businesses that you're invested in, right, in terms of the wage increases. What's your reaction to this data?
Well, I think that our experience would have suggested that 11 was much more likely than 9. I'm not an economist, and I don't know how they can conclude these estimates. All I can tell you is that across the board, in every business we're involved in, we are facing, significant wage pressure.
Yeah, I mean, and significant wage pressure is just one pressure on the part of corporations, which is why, people like Stephanie Pomboy, who's been on this program and is a regular, she'll be back tomorrow, are saying, look, the Fed is out of control and missed the mark, and we're probably going to see a big sell-off. The market is way too optimistic about this. What do you think?
I'm not quite that sanguine. I definitely agree with her that the Fed, has missed its opportunity to be the disciplinarian that it should be. We have to dramatically reduce the liquidity available in the market. We gotta sell all those bonds that we've been buying every month, and we gotta push interest rates up. I don't think that interest rates going up another 100 basis points in the next 12 months is going to throw us into a recession. I think it's much more likely if they don't go up 100 basis points in the next 12 months, that we'll have serious problems. We need to reduce liquidity. We need to stop that sloshing around of all that extra capital. And that might mean a reduction in consumer demand. Initially, unless interest rates go up faster or more than what I'm suggesting, I don't think that that's the case.
So I moderated a panel yesterday at the Milken Institute Global Conference in Los Angeles, and your name came up when I was talking to Barry Sternlicht, Starwood Capital's chairman and CEO. He talked about what he's expecting from this market, despite the Fed saying we're going to have a softish landing. Watch this. The market's going to get worse than where it is right now.
Yeah.
How much worse?
It's going to get worse. I mean, the Fed will raise rates. It is going to freak people out. Markets will continue to adjust. We favor Europe over the U.S. because rates won't move as far as they will in the U.S. I mean, they're not going to, they can't afford, they were never growing that quickly either. So they can't afford to pay 3 or 4% on paper. And obviously, German bunds have moved to like 50 bips or something from negative. That's like a hurricane. That's like a catastrophe over there.
So what about about the global story, Sam, what's your take on Europe right now? Bank of England this morning raised rates, and they said they're expecting a contraction in the UK economy in 2023.
Yeah, I think that, I mean, I'm not necessarily in agreement with Barry on his views, but I think, you know, the problem exists in Europe, and the problem exists in America, and the problem exists in Japan. You know, the world is overrun with liquidity and overrun with a lack of discipline, and things like Ukraine, et cetera, and food security are only making things worse. But I think the first and most important thing is to reduce the liquidity.
Yeah, and, you know, unfortunately, the Federal Reserve was buying securities like 3 seconds before they started raising interest rates. I don't know why they're moving the, you know, the runoff back a month as well. Why so slow in unwinding this balance sheet, you think? And is it the right move?
I mean, I think that, you know, we would like to think that the Fed is independent. Maybe the Fed was independent a long time ago. It certainly doesn't seem to be as independent today. And he's just like the Fed delayed action when Trump was beating them up. I think the same scenario exists today, where the Fed is trying to mix, you know, some kind of a formula that will avoid, you know, getting them in political trouble. And that shouldn't be a criteria of what they're doing.
Yeah, it's a great point. And of course, I think that's one of the reasons he said transient for so long. Inflation is transient, 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 we kept hearing. And that was right before he was supposed to be confirmed.
Yeah, well, I mean, you know, I looked up, when I heard the word transitory inflation, I actually looked it up to see what it meant. And of course, there never was such a thing as transitory inflation before, a few weeks before he was confirmed. So I thought it was a joke then, and I think it's still a joke now.
Well, I'm glad you brought up food security and Ukraine, another major issue. Sam, it's been wonderful talking with you. Please come back soon. Thank you, sir.
Thank you very much, Maria. Pleasure to see you.
All right.